Hi guys, welcome back to my YouTube channel. As a part of option buying series, I am coming out with a new video that is reversal strategy for option buyers. If you remember in the first video I said for option buyers, when you buy a call option, you need an immediate momentum on your side. That means you buy a call option, immediate market has to go in your side, then only you can make profit. If you buy a put option, immediately market has to go down, then only you can make profit. So that means most of the time you should take breakout trades, and if that breakout is real breakout, then you can make big profit because momentum is very strong when breakout happens. But in this video, I am going to discuss about a reversal strategy. That means it's not a breakout but a reversal strategy, especially for option buyers. And when I backtested it, and you know that normally I backtest it manually, and I've seen that almost 70% win rate in this strategy. And another good point about this strategy is you will see very frequently this strategy on your chart. After this video, when you do the backtesting about this strategy, you will see that this strategy works most of the time and it happens very frequently. So now, without wasting much time, let us see what is this reversal strategy is all about. Okay, this is the reversal strategy for option buyers. First, I'll discuss about the criteria which should be on your chart. And the first criteria is applicable only when day's first 5 minutes candle is a big bearish candle on 5 minutes time frame. That means the first candle of the day, first 5 minutes candle of the day should be a big red candle. It could be bald candle like this without wicks. It could have a wicks on one side, or it could have wicks on both sides. It doesn't matter which side is the wicks. What matters most is the body of the candle. If you see the body of the candle bigger than wicks, then this is the candidate for our strategy. Now let us see what is the next criteria. Next criteria, once the first candle made a big bearish candle, then you see price going up on higher side. Instead of going down, price starts going up. So what you should do is you should wait patiently for the retest of first red candle high at somewhere in mid afternoon. That means this strategy is not applicable at the opening. This strategy is most applicable at the mid afternoon, preferably with the series of bullish pin bars at the high of the red candle. If you see this kind of setup on your chart, that means huge bearish candle. After that, there is no follow up on the downside. Rather, market is going up. And when price comes near the high of the red candle, you will see series of this kind of bullish pin bar. If you see on the chart, then that is the second criteria. And now the third criteria is short entry once consolidation range breaks. What is the consolidation range? This is the consolidation range, right? So once that series of pin bar, which I said, you have to wait till the series of pin bar near the high of the red candle and mark that range where it made a consolidation, and your entry comes once big red candle comes and takes the and closes below the low of this entire range of the pin bar. That is the entry. So that means next time when you see this kind of price action, days first is a red candle, then series of bullish candle, and when price comes and start making a consolidation near the red candle high but doesn't break it, okay, it doesn't break the first candle high, makes only consolidation, then you will wait patiently for this kind of candle, red body candle or a bald candle, this kind of candle which broken the range of this pin bar, that is your entry. Okay, so now before we go and see some real charts, now let us see what is the psychology behind this price action. You should remember that price action is not random. There is always a psychology behind price action because market goes up and down because of the buyers and sellers, right? When there are more buyers, market goes up. When more sellers, market goes down. So now what I am going to explain here, listen it carefully so that this strategy makes sense for you, and next time you will also understand how to read price action on the charts. Okay, first one, day's first big red candle, signal of big players are bearish that day. Big players having the stop loss above that big red candle. That means whenever you see day opens with a big red candle, that means this red candle is formed by big players. Big players are bearish on that current day, but big players can't fill millions of order quantity at one go due to liquidity, so they silently keep accumulating at the higher price where they get better fill. What I mean by that, for example, assume that Bank Nifty opened at 42,500. Okay, assume that Bank Nifty when opened 42,500. Okay, they shorted at the 42,500 and first candle only made say around 300 points down. First candle only fell by 300 points. Okay, remember when big players are buying or selling, they don't buy or sell like in few hundreds or few thousands like a retail traders do. They don't buy and sell in few lots like 10 lots, 100 lots, 50 lots. No, they buy and sell in millions. Okay, that means they always place big orders. That's why they can take market up or down. So that means assume that suppose these big players have a 10 million order, he has to place sell order. Okay, 10 millions, he has to place sell order. Just remember that if we sell all 10 million here, what happens? It makes a huge red candle. It makes a huge red candle. Maybe in the single candle only you will see almost 700 points down, right? And another thing is that entire 10 million will not get at this price. Since price is going down, his 1 million get here, his next 1 million get filled here, 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 next 1 million get filled here. Like that, he will not get at the best price. What is the best price for him? Best price is when he get this price. When market opened 42,500, that was the best price for him. Now he has to buy at 42,100, 42,000. So that means he has to buy here, right? So that what he should do to get his orders filled, because if there is no liquidity, his order will not get filled at the best price. So he is interested only in filling around this rate, right? Now what he will do, along with the operator, he will manipulate the chart. That means he will manipulate the price action along with the operator in such a way that price looks like it is making a reversal. Okay, it looks like price is going up rather than going down. That's what I mentioned in point 3. As price going higher, retailers believe it's a bullish structure and they start buying aggressively. You know, when price is going up instead of going down, retailers start aggressively buying here. They aggressively buying. Why they start aggressively buying here? Because of the greed and fear. What is the greed? Greed, if you look at this price action, it gives you an impression that in the live market, eventually it is going to make a breakout. It is making a consolidation and finally breakout happens, right? This is how it looks like in the real market. That's why retail traders, they become greedy. They don't wait for the price to make a breakout. Rather, they will start entering here only. They will start entering here only before the breakout. Before the breakout because of the greed. Second thing is that because of the retailers suffer from FOMO. FOMO means fear of missing out. So that means they think that if I don't enter here and finally when breakout happens, if candle makes like this, then I have to buy here after the breakout. If I buy here, I'll get best price. They will think in that way. That means before the breakout only, they think that it is going to make a breakout, and that is what big players also want you to believe that. That means they will manipulate the price action in this way, making this kind of bullish pin bar candles to make you believe that market is going to make a breakout. And same time what they do, same time I told you that they may have 10 millions order, right? 10 million order. They don't want to sell it here, right? They don't want to sell it here. They don't want to sell it here. They will get better price here. As retailers are buying here, they silently accumulating here. Okay. Big players are silently accumulating at a higher price, and all that 10 millions order get filled. Now they get a very good price at the top. Now what they will do? They will sell off all 10 million lots, and that what leads to big bearish candle, and it leads to panic in the market. That means buyers who went long here at the opening, they all are getting trapped now, right? They all got trapped because they had their stop loss here. There was a big stop loss here. There was a big stop loss here. All buyers, retailers got trapped here. And what happens when there's a big sell order here? When there's a big sell order stop loss here, market keeps going down. And who makes profit? Big players makes profit. How? Because big players was not buying here. He was just selling silently when retail traders were buying. And once his all 10 millions order got filled, he punched all sell order at one go at higher price, and market started going down. because retailer got panic because their stop loss started getting hit and they're forcefully exiting by squaring off their position, which leads to big move on the downside. So that is the psychology behind this strategy. So if you have not understood what I discussed about the psychology, rewind the video and see it again and again until you understand. Because if you understand this kind of psychology, then reading the charts, reading the price action becomes very easy. And that is what I discuss in my new course, that is the 25 day trading strategy Nifty Bank Nifty, which I launched recently. You can check the details below this video in the description section. In that video, I discuss similar 25 strategies with how to read charts, price action on the basis of buyers and sellers. And now we'll see some real life charts. That means we'll go back and see some historical charts where this similar setup happened, and let us go and see how this price action worked, how big players trap retail traders to make profit. Okay, now let us see a couple of chart examples to understand this strategy better. So this is 9th April chart where similar setup happened. First criteria is day opens with a huge bearish candle. You can see that day opens with a huge bearish candle. That means sellers are in control. They want to take the market down on this day, that is 9th April. After that, you can see that there was no follow-up. Big players have a sell order here around this price. They want to sell 10 million quantity. What is the price that time? 22,765. Okay, that was the open of the day. So assume that big player have a 10 million sell order today. He has a plan to sell at around 22,765. He want to sell 10 million order. Okay, but if we sell all 10 million at one go, you can see that there will be huge bearish candle. Because of the selling pressure, you will see that price will go like this, and price will go, he will make profit. But will all 10 million will get filled here? No, all 10 million will not get filled here, because he needs, when he's selling, he need buyers also who will buy from him, right? When there is no liquidity, maybe 1 million will get filled here, next 1 million here, next 1 million here, next 1 million, like that. He will not get entry all 10 million at 22,765. His all 10 millions will not get filled here. It may get filled in different prices, maybe all the way till here, right? So what is the objective of when you sell? You will sell at the high, right? When you sell high and buy low, you make profit when you are a short seller. Same thing when you want to buy low, and when market goes high, you want to sell. That is how you make profit. Same thing, if he wants to make good profit on 10 million quantity, he has to sell at around this price. So he needs liquidity. So that means he has to push market up. And what retailers thinks, oh, market is going up, that means market will make a breakout. So what they will do? They start buying here. And when price comes near the high of that red candle, price will go and get stuck. And why it can't go and immediately break it? Because seller will not allow you to break that level, because he has a big stop loss here, right? So he has to keep the price below this stop loss, but same time he wants to give you bullish view also. So what happens here? There are retail traders are buying here, expecting market to make a breakout. Even before the breakout happens, they are aggressively buying. When they are buying, where is their stop loss? Their stop loss may be below this range, right? Big sell order. And when price is making consolidation in this range, what this big player is doing, he is silently accumulating. Okay. When buyers are buying here, he is silently accumulating at this price. Now he is getting good price around this region, right? Around this region. And once his all 10 million quantity got filled, now he started selling. So that he got all 10 million got filled around this price, and market started coming down. Why market started coming down? Because there is a big sell order here. Many sell orders here, because there are many stop losses, because there are many retailers who took a long position at the opening. Now that trapped, right? All the stop loss getting hit. There's a panic in the market, and price kept on going down, and big player who sold here, he must have squared off when market is going down and made a big profit. And the next example is Bank Nifty on 6th May. Day opened with a huge bearish candle. right? Immediately there was a reversal. His stop loss was above this candle, but you look at this. He did not allow price to go up, right? That big seller did not allow price to go up. He reversed from that position because if market start going up, his all stop loss going to hit, right? So he will not allow you to go up so easily. And after that, what happened? After that same price action, it started going up and then it started making a accumulation here with a pin bars and giving you impression that market is going to make a breakout, and many retail traders started aggressively buying here thinking that sooner it is going to make a breakout, because in the live market, if you look at only this much price action in the live market, what it gives you impression that price is going up and it's going to make a breakout and you are going to take a long position. So that is what happens. And what big players will do, big players silently accumulating here, and once his all quantities are filled, and he will start aggressively selling, and which leads to big down move, right? So retail traders are aggressively buying here, and this big players, he is getting the liquidity because big players are buying, he is selling silently at the top. He will not sell all 10 lakh quantity at one go because he silently accumulate maybe 1 million, half million like this, so that he doesn't want to show you big candle immediately until his all order got filled. Once his all order get filled, he will offload his position and makes profit. And all the liquidity stop losses which are there below this range, all the stop loss started getting triggered, and all these buyers got panicked, and big players make profit at the cost of retailers stop losses. Okay guys, that's about today's video about reversal strategy for option buyers. When I backtested it, I've seen that almost 70% win rate. So I highly recommend you that you also do some back testing, because the strategy have a high win rate and also good risk reward rate. And that's all from my side. If you are interested to learn more about price action, more about day trading strategy, go below this video in the description section and check my new course, that is 25 day trading strategy Nifty Bank Nifty. If you are interested, you can purchase that course. So that's it guys. I see you soon with a new video. Until then, bye and take care.